When you have a country, forget the name UK, if I just gave you the number, 6% current account deficit, 6 to 7% fiscal deficit, inflation 10 to 12, and rates of 2, no matter what will be, you'll just sell it. Then, because you say it's the UK, says, hey, come on, these numbers don't apply to the UK. So actually what the UK just found out, if you look at the data and the raw number, and you take out the flag, you've already sold it. And so what's happening is they are reckoning that UK, it's 1.5% of global GDP, pound is about 3% of reserve status, and it doesn't deserve to be so because, they're burning paper. You have a twin deficit and 10% negative real rates. No one would hold this paper, just using a brain.
Just now, Jane, with a rather extraordinary statement saying that they are planning a gilt market operation, which is an intervention from the Bank of England, they say, to try to restore orderly market conditions. Let me just read out part of this statement, literally just in the last few minutes from the Bank of England. To achieve this, the bank will carry out temporary purchases of long-dated UK government bonds from the 28th of September. So that's what they are planning to do. Obviously, that's from today. The purpose of these purchases will be to restore orderly market conditions. The purchases will be carried out on whatever scale is necessary to affect this outcome. On whatever scale is necessary to affect this outcome. The operation will be fully indemnified by HM Treasury, so it's been coordinated with the Treasury.
The United Kingdom's debt market and the fiat British pound took further historic losses this past week, as the pound spiked downwards to an all-time low versus the fiat US dollar, and the Bank of England was forced to intervene and begin buying its own debt, as it was facing system-wide pension defaults if it had not done so. Kerrin Rosenberg of Cardano Investment Chief Executive stated, "If there was no intervention today, gilt yields could have gone up to 7 to 8% from 4.5% this morning. And in that situation, around 90% of UK pension funds would have run out of collateral. They would have been wiped out." As the Fiat Federal Reserve continues hiking rates faster than at any point in the last 4 decades, it's becoming seemingly a weekly news item where something blows up somewhere in global financial markets. Since the 2008 global financial crisis bailout era kicked off, the percentage of US companies that are effectively zombies, those whose debt servicing costs are higher than their ongoing profits, has exploded. And now it's more than 1 in 5. And so one must ask themselves, how might these companies fare if rates continue to climb in the USA in the coming months? And how many of these large bankruptcies might we finally begin to see as this recession becomes obvious to everyone?
Hello there, on behalf of SDBullion.com, this is James Anderson with a quick SD Bullion market update. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible Bullion giveaways like this one.
Get ready for SD Bullion's Monster Box sweepstakes that includes 500 Silver Eagles. You could be the next lucky recipient of a phone call like this.
This is Dr. Tyler Wall, CEO of SD Bullion. Well, I'm calling you to let you know that you won the SD Bullion giveaway of a Monster Box of Silver Eagles.
So click the link below for your chance to win.
Click the link below to enter our new 500-ounce American Silver Eagle coin Type 2 giveaway contest. And good luck to all of you who take part.
Silver and gold spot prices climbed slightly this week in fiat Fed note terms. The spot silver price closed just over $19 an ounce, while the spot gold price ended this week above $16.60 an ounce. The gold-silver ratio stayed flat at 87. As we again witnessed relative fiat Fed note or fiat US dollar strength in currency markets continue, it's worth a moment to see how gold is holding up in relative fiat currencies, which are losing recently on a relative basis versus fiat US dollar strength. Here's a monthly chart of gold priced in fiat US dollars, where this year's sell-off in nominal price terms is obvious of late. But if we look at the gold price in fiat British pound terms, the story looks a little bit different. Similarly, in fiat Japanese yen, or even in fiat euro notes, the nominal price of gold has held in much stronger relatively, illustrating the fact that gold remains a bedrock store of value, especially during devaluing turbulent financial market durations. One major fiat currency that's not on this chart, which got a lot of run this week, is the fiat Chinese yuan, which just climbed to nearly 15-year low levels versus the fiat US dollar. Price inflation statistics in Europe keep coming in at record high levels. Germany has not seen price inflation this high since just following World War II, and German price inflation for food is now nearing an over 20% year-on-year increase. The US stock market continues to take losses near record levels in percentage terms. Through 187 trading days into this year, only the high stagflationary year of 1974, the 1931 Great Depression, or the 2002 stock market bubble into bear market performed worse on a percentage basis to date. The S&P 500 is now down nearly negative 24% on the year. This horizontal chart shows you how that stacks up visually since the 1930s Great Depression. Adding insult to injury is the simultaneous bear market in bonds, making ongoing losses for 60-40 portfolios at Great Depression loss levels thus far in 2022. We've only been at this bear market in paper assets for 8 months now. An official recession has not been declared yet, and given historic data, this bear market can continue for years to come. The 2000 stock bubble bear market lasted 31 months, and we're coming off blowing out the biggest stock market bubble of all time. In a sign of what the fiat financial powers are actually trying to achieve underneath all the ongoings, a secular long-term attempt at inflating away the record nominal debt levels we have accrued until now via currency debasement. When measured against the US economy or the United States' GDP, gross domestic product, America's public debt is setting up to post the biggest drop in at least 2 decades. And this is being achieved by having real price inflation in the teens while paying interest rates still not that far away from zero. Billionaire investor Stan Druckenmiller was interviewed this past week on CNBC about the still staggering size of U.S. unfunded liability levels, which at their net present value are estimated well over 100 trillion, perhaps up to 200 trillion, and that completely dwarfs the now near 31 trillion in debt that the U.S. has accrued to date. Have a listen to his sober take as the world quickens further towards an eventual sovereign debt crisis crescendo to come.
There was a time you went to college campuses and you talked about an equity and debt. I think in this case it wasn't necessarily Fed-induced, but it was entitlement-induced. Yeah. And it could come, this was 10 years ago, and I think you said sometime between, Nostradamus. You said 2020 and 2035.
Yeah.
So it's is it 2022? Is it happening?
We are in deep trouble. So everything I said at those colleges is worse in terms of the metrics, except for one thing. And what I miscalculated was I didn't calculate zero rates, I used 4% rates. But the only thing Donald Trump and Hillary Clinton agreed on in 2016 was don't cut Social Security, don't cut entitlements. So nothing was done. Joe Biden has excoriated Rick Scott because he dared mention maybe we shouldn't be increasing senior pays. But if you look at the reversal I just talked about, and you use the CBO estimate, which is rates at 3.8%, which I think, frankly, is pretty optimistic, given all the things we've talked about. By 2027, the interest expense alone on the debt eats all healthcare spending. By 2047, it eats all discretionary spending. So we're now getting into fiscal dominance. By the way, by 49, it eats all Social Security. We're getting to the point now where the interest expense on the debt is so high that it's going to eat up our ability to basically service the next generation. I'm not even sure about the current one.
Okay.
I brought some cyanide if you'd like one.
No, I'm thinking about that, and I'm thinking maybe we'll be okay, but
yeah, because we'll be dead.
Yeah, that's what I mean.
Physical price premiums over ongoing spot prices on important bullion products like 1-ounce gold eagle coins and 90% pre-1964 silver coinage, they're reaching high levels not seen since the 2008 global financial crisis. illustrating that bullion buyers intuitively know the hundreds of trillions of underlying fundamental factors, likely to not only store value but also drive bullion values well higher in the years to come. The COMEX registered deliverable pile of fractionally reserved silver 1,000 ounce bars continues to shrink, now just over 42 million ounces, or a mere 800 million fiat Fed notes would clear that exchange of its deliverable silver ounces. And those of you out there who can afford to are likely also buying bullion at increasingly record-sized rates. Continue to take advantage while spot price weakness lasts. That's all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves and those you love.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.